this one we are going to particularly be looking at these records, the record management. Others call it record keeping in the finance office. So now records, we have records that we use these records to track transactions, cash inflows and cash outflows. And so without tracing transactions, it is hard to give accountability, and almost impossible. And if one gave accountability without these source documents, then that accountability cannot be considered as valid. So we have what we call source documents, and we also have support documents in accounting. So one of the source documents, this is now looking at cash inflow, is called a receipt. We use this receipt to track or trace all transactions where incomes are received or cash inflows. We always in accounting differentiate cash flows from income. Cash can flow in which is not necessarily an income. For example, loans are not incomes, but they are cash inflows because we treat them as liabilities. So this receipt is written to acknowledge that the finance office or the accounts office has received finances, cash, from stakeholders. You will see receipts, you're always using these receipts. So the first thing on the receipt there is a date. This date is very key. If one wrote a receipt without a date, that one is not an accountant, a finance manager. Usually it is the first thing. It's not put anywhere at the bottom. Then the purpose for receiving thanks from, that's now the payer who is paying the sum, and then the purpose is here, the purpose for receiving that money. If it is for uniform, specify that it is for a uniform, not fees. If it is for socks, then it is for socks, not a tie. That purpose here will tell us which account to affect. If this purpose is not defined but the amount is there, we cannot have money. We don't know which account it belongs to. So, but also very importantly is this receipt number, the code of the receipt number. This one is a template, so the receipt number sits there. Each receipt has its number. There are some institutions where some people can have receipts without your knowledge, and can issue similar receipts and a similar stamp. And the only way you can differentiate that receipt from the known one is this number. So in accounts there is a receipt number. You can punch in a receipt number and find that that receipt is not known by you. It is not there. Or check the dates. These signatures they can create also. Yes. Signature is hard. But this they can create the, and many people cannot actually put attention on signature. The thing is, have I received the service? Have I paid? The time they come back, but this you can trace the carbon copy. Usually there are carbon copies behind there, but these days they are digitized. The system can issue a receipt. So system receipts are better. They can actually eliminate all those, unless those people also initiate their own system that issues receipts digitally. But what we do is, sometimes these digital systems, they send email, they can send a text message to a centralized place, a point where you can reconcile who has received the award. But so here you will see the receipt can be written whether the transaction has taken place at the bank or it is at hand. Even when the transaction has taken place at the bank, some people can actually require this receipt, and actually posting those transactions is mandatory. But to remove duplication, these days you can tag the reconciliation between the bank and the software, so that there is no double posting.
Excuse me, doctor. Somebody was talking about the bank slips. We have had people who are so crafty that they will even forge a bank slip. They bring it with stamps from the bank. When you're reconciling, you realize some money is not on their account. People forge bank stamps. Homes are just still paid, tuition cleared. The receipts, the bank slip is.
And then for you, your receipt
is also stamped.
Because the bank statement on a monthly basis. That is true. If you don't follow one by one, you may not realize.
Because this is how we post transactions, how transactions of the bank or are posted in accounts. You post from the bank statement, but because the bank does not capture some details, you rely on the slip to inform you of some of the details which may not be clear with the bank. The bank can assign a code, its own codes to a learner, and which
When checking, it is
2000. Yes, it happens. No, you can tell you, you see, I'm going to pay 400. Then on the message it comes up missing.
people's decisions change.
Even somebody tells you tomorrow I'm paying 500, he pays 100, then he calls you and tells you I'm paying 500. Looking at the school it is
100.
There's that reconciliation that should take place, bank versus accounts of the what, of the institution. That reconciliation, so that whatever is on the bank account is what is reflected in our transactions here. So usually when the term begins, the term has begun, you, in all these private institutions and government institutions that charge, you initiate the term with the raising invoices. Nkubanja, yeah. I will raise invoices to every student. Whenever the person pays either installments, you keep on reducing the balance, because they are running balances that keep reducing. So you can run even a statement for the parent. Here, another these are invoices. For an accountant to acknowledge that there is either a liability to pay, there should be an invoice from the service provider. So invoices are two-way. We can issue the invoice in case somebody is either taking services on credit. Nkubanja, I say any invoice you issue is Nkubanja. If I gave you this invoice today and you accepted it, that's the amount you should pay me. So on demand, that's what you are demand for when the date for paying this invoice comes, the due date comes. So those are invoices out from you to others. Then those are the ones you call creditors. So you call them debtors. You call them debtors.
Those are invoices out.
Invoices out because they have got to pay you money. The overbanja debtors. Usually, parents, you issue digital invoices. Systems, you issue the invoice. You create the invoice, but you don't necessarily issue it to the parent because you have already negotiated and possibly. But trying to claim for money from a parent without the invoice, demand notes now, you demand what is on the invoice. Then they are doing it right. That one, this invoice you see is the biggest, it's the biggest asset in all the tools of transactions. This is what is used even in courts to demand. It is very hard to demand for money from a person who you didn't issue an invoice. Even government, if when you initiate like a return, they give you an acknowledgement of receipt of the return, and that acknowledgement is a raised invoice against you.
We write an agreement. If we don't use that, we write an agreement.
An agreement, yeah, the agreement can also work, but then you will need witnesses to it. Invoices, you don't need witnesses. You don't.
What about a delivery note without an invoice? Someone gives you a delivery note, but fails to give you an invoice. What are the implications? People want to pay this to pay.
Because usually what you see as an invoice there has a legal implication and also has a tax implication. I've had several occasions where the business community is complaining in the city that landlords are not issuing them invoices, but want them to pay. You pay, there are no receipts. They don't give them receipts, not even. Because these days, URA is making sure that this invoice is called an IFRS invoice. You issue it through the system of URA so that the VAT on it is collected very well. Actually, it is URA that issues the invoice to VAT registered businesses. So whenever an invoice is issued, it can be used to claim for taxes. So when they issue the invoice, you can go and claim for taxes even before paying that invoice, which many business people don't want to do. They don't want to issue them because the tax on the invoice is claimed from URA. These are invoices these come from suppliers that have delivered services to you or goods. Then when you receive these invoices, you need to keep them on the file, or even if it is electronic, you can print it out. Those are the creditors that go in the balance sheet as accounts payable. The people should be paid. The ones you should pay. Creditors. The debtors should pay you. So actually they are having your money. We actually call them
invoice is what you have to pay for. Ndi bw'aba kuleetedde ebijanjaalo n'akuwa invoice ebyebanja ggwe gw'olina okumusasula.
Okay, that is good. Then there is
when they are paid, when that invoice is cleared, I issue out a receipt.
This one, when you pay a creditor, the creditor signs in
Creditor to give me
a receipt. Yeah. When you pay a creditor, the creditor gives you a receipt, then the creditor signs in the payment voucher that he has been paid. Yet for invoices out, when you issue the invoice, when this person pays, you issue a receipt. Unless it is an institution where they also give you a payment voucher to back up that you've paid them. But usually the receipt is enough. Here, the payment voucher. This is now to trace cash out. This payment voucher, you write this payment voucher for all the cash outs that have been incurred. Whenever you spend money, the payment voucher is written. So when there are a series of transactions, they can also be written on the same payment voucher.
Is it the same as the receipt?
No, a payment voucher is different from a receipt. So this one, when cash is going out, you're spending it, you write a payment voucher. But whenever you receive money from others, you write a receipt. Okay. So this one you use it to pay. You're paying staff. Are you paying electricity? Are you paying for fuel? Are you paying for airtime? You write a payment voucher that cash has gone out, and the person to whom it has gone to, responsible, you note that name here. And the amounts in words, then prepared by, authorized, then received. That person receiving that money should write here. If you have a staff you're paying salary and does not sign here, it is by mercy that will not claim again for that salary. That's why some people avoid and pay by check or by bank, where you will not deny that that is my bank account. But even when there are other service providers and they have not signed here, they can deny a payment. So this one is the one we call a payee, and the one to be paid is a payee. The one who is paying you is a payer. And now the one you're paying is a payee, and you are now who is paying the payer. Hmm? Mm-hmm.
But sometimes you find out that because we had a scenario, we paid money at the bank. It was for the month of June. So the teacher was like, he had gotten a loan. So he was like, you deducted the loan that month. Why is it that I'm still paying for the loan? Then the daughter said, that particular month I forgot to deduct it. So she was like, me, I completed the loan. So we had to go back to the receipts we got from the bank, and we confirmed that that month the money was not deducted. So we had to call her on board and showed her the receipt, and she was like, Kali.
Yeah, she was riding on your weakness. She wanted, if there was that weakness, she was going to go over it. Then there are also these other support documents. They are support documents we call. These support documents are not are very essential. Some of these are not necessarily entered in accounts. Others can enter them, but when they are entered, they don't so much create an effect. Especially, for example, the purchase order. These are orders, or local purchase orders. So when these orders are also two-way, you can make an order, an LPO, initiate it as an institution to other service providers or suppliers. Then when you make the order, they respond with the, if they have the items, they'll respond with an invoice. And then when they respond with the invoice, when they deliver those items, they come with the delivery note. Delivery note actually helps the supplier to confirm with you that you have actually received the goods in the right order and the quantities. Mainly the delivery notes help the supplier. So this is an LPO, an order note. However, you can also receive orders from the what? From the customer. They are called customer orders. Give me this, but usually in schools you don't usually get these orders, formal orders. You get informal orders and trace them by admission letter. That is, the person has ordered for a position. These ones are you use them in products and services. The credit notes is when you have supplied goods or services in in excess, yeah, in excess, and then some of which have got to be returned. So they write a return outward note, which is a reduction on the invoice. If someone has supplied you 20 bottles and you needed actually 15, they initiate a credit note for 5 and charge you for 15 other than the 20. It's a credit note. But debit note, they have undersupplied. Instead of supplying you 30 items, they have supplied you say maybe 25.
20.
So debit notes are actually an increase on the invoice. It is like adding on the invoice so that you pay more, then they supply more. But this is essential. These ones are essential for record keeping. And so one can ask, why did you pay the invoice? The initial invoice shows 2 million. Why did you pay 3 million? Then you have to give an accountability that there is a debit note which they added something on the initial invoice. That's why it raised to 3 million. You negotiate and reach at some point where the supplier says, I made an error, add me some more. That supplier has got to add it to create a debit note to add on the invoice, the initial invoice. Others just do a withdrawal of the initial invoice and substitute it with a new invoice. But where the invoice was already captured in books and withdrawing it from transactions which are already captured in the reports is hard, then they initiate the debit note or credit notes. Now, I would like to shift from here and just have a little glance at the books of accounts. Now, the book of accounts I'm showing you here, this is called a profit or loss account. Others call it an income statement. Income statement. Okay. Profit or loss statement. Others call it P and L. P and L. P and L statement. Instead of statement, others put it a report. This one tells us what has come in from sales. Usually these transactions, for example, these fees and charges, mean from each student you keep on accumulating for a period. They are usually, you run this P&L for a period and close off. But one which is legally acceptable is a period of the financial year, running from 1st July to 30th of June, a financial year. So that one says as of 30th of June. Now, fees and charges, that's now how much fees and charges have come in. Most importantly in these accounts is to separate accounts to make decisions better. So that's why uniforms are separated from fees. And if there is money for clubs, we also separated from uniforms. You need to see your performance. If there is transport and you're collecting money from transport, you also include here as revenue from the parents are paying for transport. So this one, this transport here, it was important to include this transport as revenue. This is money people have paid and you've issued them receipts. Here, receipts. So the receipts work here. Others call this revenue from sales. Just add a little detail here. You will see that here what I call the fees and the charges, there were holiday packages charged. These ones were not charged. Meals for morning were not charged, but study trips were charged. And then cash, swimming pools, this one was collected. Transport was collected, some money. And also tuition. This tuition is now the main one that the institution gets. I just created a summary here.
So these ones are the sources of income or sources of revenue.
Yeah, cash has come in from sources of after delivering services or selling a product. But then what did you incur to make that revenue? For example, selling a uniforms here, you have to have purchased those uniforms. So we call them costs of goods sold. Those are the only items that are being picked from the stock and are sold. Cost of goods is sold. So whenever you sell a uniform at 200,000 shillings, but you bought that uniform at 15,000 shillings, you see that? Yes, we say that you have made a gross profit. Gross profit here of that 200,000 shillings from this the 150. So what is your money is the 50. This one is the supplier's money. Possibly if they have supplied on credit, here you have a series of invoices from these suppliers as accounts payable. You have to pay.
Now, excuse me, sir. If there are those items that are provided within the school, maybe we look at the school canteen. Is there a percentage the school canteen has to contribute to the school? Because when we are looking at sources of income, we looked at the canteen. So does the canteen contribute a particular percentage to the school?
If it contributes, you include it here as one of the revenue sources from canteen services or rentals, renting facilities.
That is if it is by the system there. There are schools where the canteen is not taken as a source.
Yes.
It is a project to a given group, like a group, like teachers. So there is no way you can have it there as one of the sources.
And even if it is for teachers, she's saying that they also have to contribute something.
It is not a must. It is. I don't think it is a must.
It depends on the institution. If it has made it in such a way that they have got to contribute to the school, then it is an income source for the school. Accounting for it, you include here. At members here, what you maybe need to know is that what we call income statement or profit or loss, this money here does not mean that it has come to you've received it from clients. This is the total money that should be received from the clients. If it is that, even if they have not yet paid,
Their estimates, should we say their estimates?
Whenever you start the term, you initiate invoices for everyone, whether as paid or not. All that you have issued registers here in the income statement as revenue, income, as income. Yes. So it will hold in an account within the balance sheet called accounts receivable. That's money you should receive. And whenever you receive money, this one is not affected. This one captures what you must have sold. whether people have paid you or not, because you want to see if the business is operating. The purpose of this statement is that if the business is operating and has all those clients, and whether they are paying, but they have taken the goods, they have not yet paid, that is your money, is there. So it is, you can budget on it. Though you are not having it to use it currently, you can budget on it. So all this has what you have sold and also what you sold on credit. This money here, what you've sold in cash and also in credit. But wherever you sell an item, like here, children have already eaten food here, and so the cost of what they have eaten from what you bought from the supplier is this money. But this school made it in such a way that people don't pay for meals separately from school fees. Someone just pays the school fees,
and
you provide the meals. You don't tell the person then pay for meals. That's why this one is here, but it is within the what? The fees. School bus, transport, all that is in the fees. So, and then these other costs of serving them. Then the difference between the sales revenue and the cost of goods sold is what we call the gross profit. That would be corresponding to the 50,000 we saw that side. If it is less, then it means that you are in the worst position. That's why institutions have got to cost charges, costing. What are the inputs? And then they add some percentage.
Like, are you allowed to get an without specifying that it costs an audit to pay? What approach other incomes? I think
that is important to classify all accounts in the chart of account, so that there is no account that keeps on pending to have other incomes. I only summarized it here as other incomes, but in accounting it's not proper to have other unclassified accounts. Then when you spend money on goods, what we call an expense is when you spend money on an item and that money will never be returned in any way. For example, when you pay for water, that's an expense. But when you buy a uniform, we don't say that is an expense. That is a purchase. You've just converted the money from being papers to being a uniform. It is a stock. So at any time you can even sell those uniforms and turn it into money. If you bought food, it is a stock. It's not an expense, it is a purchase.
But it is consumed.
Whatever is consumed now is what comes out here in cost of goods sold. But what remains there is still your money. You can even sell that portion to the shops.
At the end of the term, maybe you go to the store and look at those items that have remained. Then you convert them into cash.
Yes, because they are stock goods. They are stock items. They are not expenses. You don't call them expenses.
No. If they are 50 kilograms of portion, Then how much money is that? Hey.
For example. So
Then
do
you
say
have cash of emitwalo munana.
uziza mu maduuka ne bareduce.
That is it. Sorry?
Also, that is to be consumed by the banks.
At the end of the term.
It's not an expense. It is a purchase.
Because you are selling that food in Uganda.
Yes.
You are gaining from the food.
When you buy desks, tables, it's not an expense. It is a purchase.
What are some of the expenses?
Chalk.
At the end of the term, if you have remained with 3 boxes of chalk, you convert the 3 boxes of chalk into cash.
Why do I have to remain with some?
Would you force them to overwrite?
There's nothing that has remained. Yes. You buy chalk to be consumed. What if by coincidence you find some remains that bad? Are we looking at the remainders and then the ones that were referring to as purchases?
Yes.
No. As
Those all can be turned into money.
The whole thing.
Stock left it at the end of the
So now you can see
stock left at the end of
that these people are making losses. When you get gross profit, take away all expenses. The expenses are this is the gross profit. Then they are making losses. Just assume that if all these people paid the fees and all of them have paid and have completed, and you incurred these expenses to this level, you'll be making losses. You need this money either to get it as a loan to keep the institution running, because you're spending beyond your gross profit, meaning you're spending even you've spent all the money that you have. Now you've entered into suppliers' money. What you purchased here, for example, this person with you're paying for meals, their children are eating the meals, but you are not able to pay for them. Why? Because you have a larger loss that is eating into your stock. So the solution, if we are creating a solution for this institution, is if we project and see that next year there is going to be a change, then there is hope for reviving this institution. Yes, you see that there is some reducing loss. Possibly the expenses have dropped and the costs are here for transport have reduced. There is a change. There was a decision taken to affect the loss making. This assumes that you have collected all the money, but what we call a cash flow statement just looks at only what you have received, not what is with your creditors or debtors, sorry. Yeah, what you have received is what you call cash in. So it has cash flow statements have 3 parts. There's a part called cash in, and then another part called cash out, and then another part called net cash position. Net cash position. So this one, the cash flow statement, will only tell you what cash have you received, but this one tells you what cash should you receive. So this one will have cash at hand, at hand, that those are people who are paying it to you directly, and also cash at bank, those who are paying through the bank. Even cash in the with mobile money is cash at bank. If you have here some 300,000 shillings and also have here some 200,000 shillings, we say, yeah, now what cash has gone out? Cash out, you look at cash out going out because you are purchasing. This one looks, if when you purchase, even if you purchased desks, that cash is not with you. That is cash flow. If you purchase, and the same purchases have taken that money, and then expenses you also add expenses. So we take here total cash in, we sum that cash in and see the total. Okay, really, let me try to make sure we remain with something.